Hey everybody, Smart Silver Stacker here. I hope you're doing well today. The precious metals have been coming under some significant pressure lately. Over the past several trading sessions, we have seen gold, silver, and also platinum sell off in a fairly big way. All the metals now are pretty well off of their recent highs. I want to discuss the dynamics of this pullback because it is kind of an odd thing in markets. What's been catalyzing this is we've been seeing inflation numbers moving higher, and that has actually been triggering a sell-off in the precious metals, which is not exactly what you would expect, right? But I don't think this is a dynamic that can persist indefinitely and probably not even for much longer. So that's what we're going to be covering in today's video. And also, I'm going to be giving you my top picks for bullion to stack at the moment to take advantage of this pullback, because I do really feel like this pullback is a huge buying opportunity for us stackers. And who knows, it may be one of the last buying opportunities that we get. I mean, of course, that's not guaranteed. Timing market's very difficult, but I think that the time is getting short to get your hands on hard assets before we see a significant devaluation in the US dollar and much higher prices in the precious metals. Today's video is brought to you by Silver Botanicals line of household products powered by Nano Silver. You can check them out with the link in the description. And don't forget to use coupon code STACKER to save 10% on your order. Now, let's get into this pullback in the precious metals and what is driving it. So lately we have seen inflation beginning to rear its head again. It looks like we haven't hit peak inflation yet, at least that's my analysis. We saw the CPI begin to tick up recently, and even more recently than that, we got the PCE, that's the Personal Consumption Expenditure Index, supposedly the Fed's favorite measure of inflation, and that ticked up 0.6% month over month, and that beat analysts' expectations, and it also represented an acceleration in this particular measure of inflation over previous months. Now, why do precious metals sell off when inflation comes up? Well, we've talked about this extensively on the channel recently and in the past. We've got this weird dynamic going on where really the only thing that's driving the price action in the metals and in markets in general is the Federal Reserve, what they do next and what investors expect them to do next. And when we see these higher than expected inflation numbers, what that leads investors to believe is that the Fed is going to get more aggressive, quote unquote aggressive, in their fight against inflation. Because really, what they've done so far, even though, they might be describing their moves as hawkish, the media might be characterizing the Fed's moves as hawkish, they're not. I'm here to tell you that hiking, up to 4% or 5% federal funds rate in light of the type of inflation and the magnitude of the inflation that we have experienced, I would not categorize that as an aggressive move at all. But hey, that is the narrative. And now that we are seeing higher inflation numbers begin to come out, it's kind of ironic that just as Powell was beginning to really emphasize this disinflation narrative, and for those of you who aren't familiar with that term, it's something that Jerome Powell has been talking about extensively recently before we got these higher than expected inflation numbers. He was talking about disinflation a lot. Disinflation just means continuing inflation, but at a slower pace. But now, of course, that we are seeing the inflation numbers tick back up, that narrative has got some holes poked in it, and it doesn't look like that is the case. And of course, this is kind of par for the course for Powell, who was telling us that inflation was transitory for months, and of course that turned out to be a bunch of nonsense. And so no shock that when he starts telling us that disinflation is firmly in effect, that then we begin to see inflation accelerate once again. I mean, you can almost treat the Federal Reserve Chairman sort of as a contrarian indicator at this point. But the reason that I don't believe this dynamic can persist for too long, and the dynamic that I'm referring to is this one where, good news is bad news is good news. When we see inflation tick up, assets sell off. I mean, it is very bizarro world kind of stuff, but it does make sense because I do think that the Fed, even though they're not really being aggressive, they are going to probably hike rates a little faster maybe than markets previously had priced in. Maybe we'll be getting a return to 50 basis point hikes, maybe 75 basis points. I mean, I wouldn't rule that out at this point. I don't think markets are expecting that, but it could very well happen because, you got to keep in mind that we've got the highest inflation since the 80s, probably even worse than that actually, because the CPI has been altered over the years. So, today's CPI isn't the same as back then. So it's not really an apples to apples comparison, but at least the inflation now is at least as bad as what it was back then. And back then, Paul Volcker, the Fed chairman at the time, he had to hike the federal funds rate up to close to 19 or 20% in 1979. And it still took a while to get inflation under control, even with interest rates that high. So, with interest rates where they are right now, I don't really think there's much chance that the Federal Reserve is going to get inflation under control, but they're going to make a good, show of trying at least. And so we might see some slightly higher interest rate hikes than what we maybe had been expecting. And, the Fed certainly is not going to be pivoting anytime in the near future. But again, the reason that I don't think that this dynamic is going to persist is because ultimately the Fed will be forced to pivot. I mean, they can't keep hiking rates indefinitely, especially not in an economy as levered up as the one that we have. When you've got $31.5 trillion national debt, a record household debt, according to the New York Fed, we've got household debt at $16.9 trillion, all-time record high, credit cards at an all-time record high. You just can't keep hiking interest rates indefinitely without breaking something. And that, I think, is going to be the critical watershed moment when something breaks. There is a moment approaching. Now, I don't know when it's going to be. Maybe it'll be this year, maybe it'll be next year, maybe it'll be 2025. Who knows? But something in the medium to short term is going to occur where something will break. And, maybe it won't be because of the rate hikes. Maybe it'll be something completely unrelated, some kind of a black swan event. I mean, certainly there are plenty of events that could rock the global economy at the moment, potential events that seem a lot more probable now than they did just a couple years ago. I mean, we've even got U.S. generals saying that we're going to be at war with China over Taiwan by 2025. Now, I mean, that would certainly be something that would rock markets and could very well force the Fed to return to a policy of easing in order to try to bail out this basket case economy that we've got. But, even if the wars don't accelerate, even if maybe peace is made, who knows? I mean, I don't think that's going to happen. But even if that doesn't happen, something's going to break simply because of the amount of debt in the system that just cannot be paid off without devaluing the currency significantly and without perhaps the Fed intervening and monetizing some debt. But let's say that doesn't happen. Let's say that somehow miraculously the U.S. economy is able to withstand these rate hikes for, some period of time without something critical breaking. I mean, certainly things probably will continue to get worse. Maybe we'll go into some kind of a recession, but there may still be the ability for the Fed to continue hiking. Like I said, I mean, there's all of these events that could potentially force the Fed's hand to reversing policy. Maybe it'll be the Saudis dropping the petrodollar system. I mean, we've heard a lot about that lately. We've heard the Saudi Arabians talking about accepting other currencies other than the dollar for their oil exports. Recently, we had Iraq drop the U.S. dollar for their bilateral trade with China. Now, they happened to exclude oil for now, but the fact that they are transitioning away from the dollar to the yuan for international trade settlements, I think indicates that, eventually oil is going to be invoiced in yuan as well, the oil exports from Iraq to China. It's only a matter of time. There's all of these things queuing up that could be a tremendous blow to the U.S. economy, to the global economy. We've got the BRICS summit coming up, the BRICS summit in August, and Sergei Lavrov has said that a new BRICS currency will be on the agenda there, and also possibly the induction of Saudi Arabia into BRICS. And if that happens, I mean, what do you think the chances are that they're going to continue pricing their oil in dollars for too much longer? So there's all of these threats right now out there, looming problems, which look like they're going to manifest themselves in the relatively near future. And it's just going to take one of these events to force the Fed to return to a policy of easing. I mean, let's say that the petrodollar system does fall apart and all of these countries start paying for oil in their local currencies, or who knows, I mean, maybe even in gold or, one of these gold-backed stablecoin currencies that seem to be getting developed out there, or, central bank digital currency of some sort designed for international trade settlement. If that happens, all of these countries, up until this point for the past 50 years or so, they've had to hold dollars to pay for their oil, and they're not going to need that anymore. And if all of those dollars start flooding back into the U.S., that is going to cause inflation, yes, to run out of control. But one of the other consequences of an event like that would likely be that we would see interest rates begin to spike. Because who is going to continue to buy 10-year treasuries for 3.92% yield when inflation begins to run out of control? I mean, that's the latest yield on a 10-year treasury. And think about it. I mean, if you're tying up your dollars for 10 years for a guaranteed yield of 3.92%, you must expect that the Fed is going to be successful in getting inflation maybe down to their 2% target. I mean, I don't think that there is a chance of that occurring. The Fed will get inflation back down to 2% anytime in the near future. But obviously, investors believe that. I mean, I guess there's two possible explanations for the current yield on a 10-year treasury. One is that investors believe inflation will be coming down, or, who knows, maybe the Fed is buying bonds out there and they're keeping interest rates low and they're just not making that public. I mean, I suppose that is possible. According to the public ledger, the Fed's balance sheet is still declining as part of their quantitative tightening program. But, clearly something is very strange about a 10-year yield of 3.92% in this environment, unless you believe that investors think inflation is going to come down. That's probably the case. I mean, there has been this concerted effort by the Federal Reserve and by the financial media and more broadly by the educational system and just by our culture in general to obfuscate inflation and its true nature and what's really behind it. I mean, that's the reason that they've redefined inflation in the dictionary, and that's not tinfoil hat stuff. I mean, you can go pick up a dictionary from 1970, and the definition of inflation is markedly different from the inflation definition that you have today in the dictionary. So just, think about that. It is possible that investors may be getting the wool pulled over their eyes, and maybe they think that the Fed will be successful. But when one of these events occurs and inflation begins to run out of control, whether it just be the fact that the federal government continues to spend, $1.5 trillion in deficit spending every year, or if it's a breakdown in the petrodollar and a flood of U.S. dollars back into the U.S., these yields are going to need to move much higher. And when that happens, if the yield on U.S. treasuries goes up dramatically, that's going to not be an acceptable situation for the U.S. federal government because they're still borrowing a lot of money. They've got a lot of debt that is held in a lot of it short-term treasuries that are going to get rolled over eventually. And when you've got $31.5 trillion, every point of interest that you have to pay on that represents more than $300 billion every year. So, it doesn't take much of a boost in yields to really start to put some pressure on the federal budget. And one of the things that we might see is if these interest rates spike up, interest payments could become the biggest part of the federal budget, debt service. So that's not going to be acceptable. So, eventually the Fed is going to have to come into these markets and they're going to have to buy bonds. They're going to have to reinitiate QE. Quantitative tightening is not going to last. I mean, yes, they talk a good game about this. And sure, they have managed to reduce the Fed's balance sheet by something like $300 billion, I think, since they began this. But, it's over $8 trillion. That is a lot of money. There is no way that they can reduce that balance sheet by any significant amount before they are forced to return to a policy of quantitative easing. I mean, unless, of course, they just want to destroy the U.S. economy and eviscerate it and usher in the worst recession in living memory, which, would be the consequence of the Fed failing to intervene when we see this spike up in interest rates, which I think is coming. And again, I don't know what the trigger is going to be, so I can't tell you exactly when this is going to happen. But I can tell you that we have put ourselves into a situation where it is almost inevitable that something causes the situation to play out like that. Leave me a comment down below if you have some forecasts for what might trigger a spike up in interest rates and possibly a return to easing on the part of the Federal Reserve, because I would be interested to know what you have to say. I mean, certainly, like I said, there are a number of factors out there in the global economy that could trigger an event like that. But all of this is why I view precious metals as an absolute steal following this pullback. I mean, I thought that silver was cheap at $25 an ounce. I think silver would still be cheap today at $30 an ounce or $40 an ounce. When you look at the price history of silver, the all-time high back in 1980 of $50, you adjust that for inflation, you get a number north of $170. And Obviously we are nowhere near that, and the situation has gotten so much worse. Back in 1980, I think we had $1 trillion in debt, and today we've got 31.5 trillion. Point is here, I just think silver is incredibly cheap. So today I want to go over what I think are some of the best deals out there for stackers right now. Because, in the physical market, things change a lot. We see premiums on various products oscillating, and, there are some things that become better deals at certain times. So with that being said, let's get right into it. One of my top picks right now is 90% constitutional silver, because the premiums on this stuff have really come back down. I think SD Bullion has this right now for just over $18 for $1 face value. So that would mean two of these half dollars or 4 quarters or 10 dimes. That's how this stuff gets priced. And if you're a new stacker and you don't have any constitutional silver in your stack, this is a really good opportunity, I think. The fact that the premiums on this stuff have come down so much. Last year, the premiums got as high as, I think, 50 or 60% over spot for these, and it has come way down. And, if you don't have any of this stuff in your stack, it's just great pieces of history. They're awesome pieces of fractional silver. Whether you get half dollars, quarters, or dimes, it is definitely the lowest premium fractional silver you're going to find. And one of the reasons I love 90% constitutional silver, the stuff that was minted in the US 1964 and earlier, is because they're not making it anymore. They haven't made it since 1964. A lot of these coins have been melted down. That's why anytime we see a significant move into the precious metals market, this stuff is always like the first thing to become out of stock, to become scarce, and the premiums on it really can spike up in a big way. And so, I love constitutional silver, and I was kind of concerned last year that the premiums might not come back down, but I'm so happy that they have, so I can get some more of this stuff, and so that all of us stackers can get our hands on these awesome constitutional silver coins. Okay, now maybe you want to do something other than silver. Well, right now, honestly, with the way the gold to silver ratio is, it's hard for me to stack gold at these prices when silver is so cheap, but there is always platinum, and platinum is also very cheap at the moment. If you look for a lot of the past several decades of history, a lot of times platinum is priced higher than gold, but right now it's almost half the price. I think it's a little bit more than half the spot price of gold. Platinum is a little speculative. Let's talk a little bit about platinum first. Platinum is a more speculative metal, it doesn't have the monetary history that gold and silver do. It's a very small market compared even to silver, which is in itself a small market. One of the reasons that I think that platinum really has the possibility to have some dramatic price movement is, one thing, the size of the market, it is very small. And the second thing, where the platinum comes from, because a lot of the platinum in the world, I think it's something like more than 70% of the platinum comes from two places, and that's South Africa and Russia. Now, those are both members of the BRICS nations. There is a real possibility, I think, that the West could find itself cut off from platinum supplies if the economic warfare continues to get worse, if we continue to see more of a divide between the West and the global South and Asia, or the BRICS nations, then I do think that there is a real possibility that platinum price could be moving much higher, especially here in the West. And right now, SD Bullion has these Perth Lunar Year of the Rabbit coins on sale for any quantity. It is a bit more of a premium than you'd get for other coins, but I think that the extra 20 or 30 bucks you're going to pay for these Perth Lunar Year of the Rabbit coins is probably worth it. I actually have one of these on the way, should be getting that shortly. And if you don't want to pay that extra premium, they also have 1 ounce platinum coins of random type for a slightly lower premium. But for me, I think that Year of the Rabbit coin takes my top platinum pick for the moment. Now, if you want to do some heavy stacking, they've got some 15 kilo bars on there. And, this is way too big, I think, for most retail investors. But, I don't know, maybe you've got millions of dollars that you're putting into precious metals. Something like this might be appropriate in that case. And notably, you can get these for just 69 cents over spot. So that is one of the lowest premiums on a silver bar I have seen in some time. Although, of course, you do have to drop more than $10,000 on one of these things. But I just thought that that was kind of an interesting aside that you can get these. They're smaller than a Comex bar, and you can get them very close to spot now. And then my top pick for silver at the moment for physical silver is these Valcambi 1 kilo silver bars, which are available for $1.69 over spot. And I think that these continue to provide the best balance between premiums and manageable size of silver. And if you've been watching the channel for a while, you know I love kilo bars. I think that over the past year or so, these have been one of the best opportunities in physical metal because they're a lot smaller than a 100-ounce bar. They're much more manageable. I think in the event that you need to sell some silver, it's much better to be holding kilos than even 100-ounce bars. And the premiums are just very low, so very good balance. And there's just something really satisfying about a kilo bar, holding these things, stacking them up. They're just awesome. And so that is my top pick at the moment. But I just thought I would cover some of my top picks today for all of you potentially new stackers out there, for anybody who is wondering, where the best deals are at in precious metals at the moment. So those are my top picks. Let me know what you think in the comments down below, everybody. Thank you very much for watching, and I will catch you next time. Smart Silver Stacker, out.